We are witnessing history. Today's rally puts the S&P 500 officially up 40% over the last 12 months. This is the larger 12 months gain than any annual return in the S&P 500 dating back to 1954, and you can see it in this chart of the year-to-date performance. It's one of the best we've ever had, and I think this is a very important time for us to know and try to analyze where we are in the cycle. If this rally is getting too extended, is it only getting started? Is it nearing the end? Could we have some kind of a shift in sentiment, some kind of a major pullback? Is the market overvalued? We're going to look at a lot of different things that I believe are going to be helpful to many investors. And I'm not telling people to sell all your stocks and be in cash. I'm not trying to time the market. I'm just trying to know where we are in the cycle. And that could be very beneficial. And I was able to benefit from that stuff many, many times. I'm going to be looking at three main factors that, in my opinion, will determine if we're going to have a market pullback or not. The first one is valuations, very important. The second one is sentiment. Are people being extremely fearful, extremely greedy? Do we have just a lot of greed in the market and massive speculation? The third one, which is very important, is a catalyst, because every year you have people on CNBC and all these places on YouTube. They come up and they say the market is overvalued, we're going to have a crash, or they say it cannot keep going on forever, the market is going to crash every single year. But they never talk about a catalyst, and you normally need some kind of a catalyst or a trigger for people to start selling stocks and for us to have a market correction. And if you don't have a catalyst, then the positive sentiment will feed on itself and the market can always get more irrational. It could always get more overvalued. And there's a few catalysts that I'm going to talk about here at the end of this video. Now, looking at a basic forward PE ratio, I have to say, guys, it's getting extended. We're pretty much back to where we were in the 2021 peak. Profit margins are almost the same, I believe almost the same from 2021. And now we're sitting around 21 and a half times forward earnings, not trailing, this is forward. 21 and a half times forward earnings on the S&P 500, which is nearing 2021, not as close as we were 27 times in 99, 2000, but still 21 and a half times looks expensive. But this is by far here my favorite one, is most of the growth in the S&P, most of the earnings growth has been coming from the Magnificent Seven stocks. Amazing companies like Nvidia, even you could say Tesla, you could say Google, you could say Apple, Microsoft. They've been growing earnings rapidly. And most of the earnings growth has not been coming from the Dow stocks and from the railroads. Most of the earnings growth have been coming from the Magnificent Seven. But I just want to show you how overvalued this market is if you look at the S&P 500 X the Magnificent Seven, meaning the 493 stocks, and this is here in the green chart. If you look at it in the green, it's trading almost at the same level it was trading at in 2021, and much higher than it was trading at on a historical basis. It's trading around 19.6 times. So the S&P 500, without the seven best companies, Meta, Nvidia, and all these stocks, without the best seven companies on planet Earth, is trading at 19.6 times. This is very expensive. It's very expensive, guys, because most of the growth has been coming in from the big seven. It hasn't been coming in from the remaining stocks. But a lot of people tell me, why would you say we're going to have a pullback? Because, earnings have also been rising rapidly. Earnings have also been going up. And you're 100% correct. But the gap between the valuation and the earnings is getting very, very wide. And this is an amazing chart. It would show you in the red, which is the S&P 500 chart, and in the blue is the total forward earnings, which right now is around 4,000. This is not trailing, this is forward, so it's pricing in the growth, around 4,000. The S&P right now is trading, I believe, around 5,850. I'm not saying it should be trading at 4,000, but if you look at it on a historical basis, anytime we had a wide gap between the S&P 500 and the fundamentals, or you say the S&P 500 and earnings, it didn't really last too long, and the gap had to eventually close. They had to meet each other again or get closer. So whenever we had a wide gap, for example, it did last in 2021, but it just was not sustainable, and it had to go back to this line for it to have some kind of a sustainable rally. And from here, the gap is getting too wide, and it doesn't mean the S&P can't go higher, but it makes this rally unsustainable. So if you are a long-term investor, You want to hope we have some kind of a pullback in the S&P for it to get somewhere close to the total earnings for us to have some kind of a longer term sustainable rally. But this wide gap between the S&P and the earnings, I don't believe it's sustainable. And I think it will ultimately have to correct. So from me looking at the fundamentals, forward PE ratio, some earnings growth, and forward PE of the S&P X the Magnificent Seven, I determined that the S&P is overvalued. And I think a lot of you can agree with me. We're nowhere close to undervalued. We're not fairly valued. We're much closer to overvalued. And I believe this gap is pretty much unsustainable. And that's my conclusion for the first one. The second one, which is sentiment, and a lot of people like to look at the fear and greed index, and it's not too bad, but it's not my favorite. Although we were trading around 75, which is close to extreme greed in the market, around 75, and we started going back down, but we're still in greed territory. There's no fear in the market based on the fear and greed index, but I don't really like it too much. I like to go on Twitter, I like to go on YouTube and see what kind of beliefs most investors have, and if they're bragging about something, if they're scared about the stock going lower. All that stuff is way more important than the fear and greed index. And this is something I posted before on Twitter when I was up 47%. Now I'm up like 58 or 59%. And it's something pretty funny because I'm doing it myself. And that's when I started investing. Someone told me, if you ever look at your year-to-date return with excitement and you feel like sharing it or bragging about any returns you've made, it's time to sell. It doesn't mean it's time to get out of stocks and then not look at them again, but it's time to be cautious, because whenever you feel like you want to brag about something you did, it mainly could be the market, not your skills. And I know, for example, I'm up 58%, and I did have amazing trades this year. I had very good trades, I had very good investments, and I'm still holding them. They did amazingly well. But I know I'm also in the right market. I know the market is also going up. And if the market was going down, maybe I would not be up 58%. So maybe not all of it is skills. But this is something that most investors don't realize, because we tend to get overconfident and we believe we're the best thing since sliced bread because we're up whatever year to date and we can do it again and again and again. Maybe you felt this way in 2021. You felt undefeatable. You felt like you're the next Buffett because you buy the stock and it goes up. You buy the stock, it goes up. You feel like you're a genius. You could do this forever. You're going to be rich and all these things. And this is not reality. And whenever you see a lot of bragging, which I'm seeing a lot of bragging, year-to-date charts on Twitter, YouTube, and everywhere, it's normally time not to sell, but it's time to be cautious. And I have a few more examples. For example, on Twitter, I saw a very popular YouTuber. A lot of you know him, very popular. And he recently bought CP, a Canadian Pacific Kansas City, and it's a stock that I discuss on my YouTube channel. And I believe he bought it 3 months ago. And the stock has been flat for like 3 months, or it's down 1% from his cost basis. So he posted about it, and he said that he might be wrong on CP. So maybe he might be missing something, but time will tell, And the only way we feel this way is because everything else we own is up so much. It's up 20, 30, 40, 50, 60, 70%. It's up so much that if a stock is flat for 2 or 3 months, we believe that something is wrong. If the stock is down 5%, it's like it's down 50%, we get upset. We look at it, when is it gonna go up? We feel like it's the end of the world. This is not normal. It's only normal in the market we're in, which is when you just buy the stock and it goes up. You feel like you haven't bought enough. It's never enough. You buy whatever, it just keeps going up. This is not normal. It's very normal for a stock to be flat for 6 months, year and a half, for it to go down before it goes up. All that stuff is normal. It doesn't feel normal now because we got so used to this dopamine hit, or whatever you want to call it, that you buy the stock and it goes up, you get immediate feedback that you're right. All that stuff is massive signs to me of, a market, or massive, you could say, extreme greed, extremely bullish sentiment, massive overconfidence. And normally overconfidence is reached not just by year-to-date returns, but it's reached among a very popular stock in a specific year that goes up beyond imagination. And it's normally a very popular retail stock that causes retail investors to get overconfident, and then they believe they're the next Buffett or whatever, and they want to go find the next one. This is a very popular pattern in 2021. It's popular in 2008. It was popular in 99. Every time we have one of those two stocks that are retail favored and the stock goes up beyond imagination, they believe that they were right, they gain confidence, and then this confidence fades away in a year or two. And that's what normally happens. And in 2021, it was Tesla. And I'm not hating on Tesla because I don't hate the company. I was involved with the company for a while with some options, and I did make some money on Tesla. So I can't really complain about the stock. But I'm just illustrating an example. And in 2021, Tesla went up beyond imaginations. Most retail investors were long Tesla. They gained massive confidence. I mean, I went to get a blood test, and I'll never forget. And I heard people talking about, she wanted to find the next Tesla, but they're not in stocks or anything because they just bought it by luck. It went up. So I'm going to go find the next Tesla. But they never heard of investor relations page, which I was trying to explain it to them. And that's what normally happens. And then this confidence was unwarranted. And the stock did deserve to go up, but it went up more than it should. It's been down for 3 years, and most people are flat or down on it. Some people are still up. They bought before. But from 2021, the stock has been either flat or down. And the same stock that I'm seeing right now is Palantir. And again, don't hate me. You could dislike the video, but I'm just giving out an example. Okay. And Palantir is an amazing company, and it deserves to go up. It deserves to be up. It's a good company. If AI is the future, they're signing contracts with everyone. It's a good company, bright future, massive revenue growth, earnings growth, free cash flow growth, margin expansion, recurring revenue. It's an amazing company, and it's up 170%. And a lot of retail investors, they own Palantir. But you have to ask yourself that, yes, you're right on the Palantir's fundamentals, you're right on the growth, you're right on AI. But did you really expect Palantir to get a multiple expansion to 113 times earnings? Would have Palantir gotten a multiple expansion to 113 times if we didn't have the markets that we have right now? And I believe the answer is no. It would not have gotten this massive multiple expansion outside of this massively optimistic, massively bullish market. So what this is causing a lot of retail investors to have massive overconfidence that they are the best thing and Buffett is dead or whatever, and he doesn't know what he's talking about. And they want to go find the next Palantir. And this is when you could see the massive overconfidence that's normally unsustainable. But again, I was the same person, and I learned it the hard way. That's why I'm not too excited about my year-to-date return, and I'm trying not to brag about it too much, because I know whenever you feel like you want to brag about something, it tends to be unsustainable. And that's another one I own, Hims and Hers Health. It's up 125%. And it's in my stock, and it's amazing. But it does not deserve to be up 125%. The main reason it got this multiple expansion is because of the market we are in, and it got pumped up on Ozempic stuff and weight loss and all those things. But it doesn't deserve to be up 125% in 1 year. And it's very important for us to recognize that stuff and recognize whenever it's our skills or it's maybe we're in the right market at the right time. It's very important to know. And whenever you see such massive overconfidence, massive bragging about year-to-date returns and Palantir being up that much and Nvidia being up that much and all those things, and it's normally not sustainable. And I've seen it many times before. But in terms of a catalyst, we have a few of them. And one that was very popular on YouTube was 10-year minus 2 months, minus 2 years, which is mainly the yield curve. And it pretty much says that whenever it turns negative, after it turns positive a few months later or a year later, we tend to have some kind of a financial crisis, some kind of a disaster, and we also tend to have a market crash. And this is what happened in 2007 when it went negative. When it went positive, we had the 2008 meltdown. Same thing happened in 99. After it went positive, a few months later, we had a major pullback. And the same thing has happened right now. It went negative, and now we just reinverted, like I believe in August or September. It was in August. We almost turned positive, and it's been like 2 months or 2.5 months, and now we're starting to go up on it, and we're starting to reinvert. So there's a very high likelihood of something bad happening over the next 6 months, from the 10-year minus the 2-year telling us that we could have a recession or something very bad happen. But it has been wrong once. My favorite indicator is the 10-year minus 3 months, because it has never been wrong. It's been right 100% of the time. And it's more of a timely sensitive indicator. So once it turns positive, there's normally a short period before something bad happens. Look, see, in 99, it was a sharp one. As soon as it turned positive, something bad started to happen, and we had the starting of the recession that happens then. And the same thing is happening right now, but we haven't turned positive yet. And this is a very important one to watch. Once we turn positive, maybe you don't sell all your stocks, but maybe you could become a little bit more cautious, because it's been accurate 100% of the time. So this is the first catalyst. It could be a recession or some kind of a systemic breakdown. It's very, very possible. The second one, which is the worst one, is the trade war. A potential trade war, not just with China this time, but it could be also in Europe. So much that Europe is already preparing for a change in administration. If we have a change in administration, we're not only going to have a tariff or trade war with China, but it's also going to be with Europe. And the German finance minister, he is warning of a retaliation if the US kicks off a trade war. So it's not going to be just with China, it's going to be with Europe, likely going to be with Taiwan, with a lot of the chips and semiconductors. It could also end up being with Asia, many countries over there, and it's going to be almost everywhere. And this creates uncertainty. And the market hates uncertainty. That's why the market likes Goldilocks in the White House and in the administration, because then not a lot of stuff is changing. But whenever you have massive change, whenever you have uncertainty on what could potentially happen, the market hates it and it panics. And normally we get a multiple contraction if this happens. Despite us having maybe lower corporate tax rates, which could boost earnings, we tend to have a lower multiple because of the uncertainty that could happen. And I did try to do some research on what happened in 2018 whenever they started raising tariff. And I found this from Forbes. And they said, we found that US and Chinese tariff announcements, and they pretty much used 3,000 listed firms, and it affected them by 6 percentage points, or a $1.7 trillion reduction in market value using their sample of the $3,000 firms that are listed on the exchange. So they affected them by 6 percentage points. And that was with the tariff war of US and China. Now, what's going to happen whenever you have US and China and Europe and Taiwan and a lot of countries in Asia and all those changes that could happen in government? Maybe it's bullish, but I believe the market hates uncertainty. And this could be another catalyst if we do have a change in administration. If we don't have a change in administration, then we're likely going to have higher corporate tax rates, which is also bad for stocks. So the way I'm looking at it, there's a lot of catalysts that could cause a market pullback. There's also an extended valuation, in my opinion. Valuations are extended. Sentiment couldn't be more bullish. Massive confidence from investors, bragging about returns and all those things. That could be due to skills, but could also be due to the right market that we're in, which is the best market, you could say in 2024, best market in a century or since 1954 or something like that. So it's been amazing. And I think it's not the time to be 100% cash or to time the market. But maybe it's time to a little bit be more selective or be more cautious, maybe hold some more cash on the side. Or if you want to do like me, what I'm doing is I'm looking at a lot of defensive stocks with huge backlogs that will likely be a flight to safety if something bad happens with the hyped up tech stocks or AI stocks. There could be a flight to safety, they're undervalued, and they can go up while the market is going down. This is a lot of the stuff that I look at and have a lot of them in my group. If you're interested, this is the link. But that was just my honest opinion on the market and where we are in the cycle. I hope you enjoyed it. If you did, please press the like button and maybe consider subscribing. So I'll talk to you in another video.